At the peak of COVID, Ottawa real estate felt unstoppable. You'd list on a Friday and the property be gone by Sunday. 15 offers, no conditions, prices breaking records. But here's what most people don't realize. 3 years later, not every neighborhood has recovered the same way. Some areas are holding steady, but others, well, they've quietly slipped 10, 15, 20% since 2022. In this video, we're gonna break down Ottawa neighborhoods you should avoid and think twice about buying right now. What's driving these prices down, and what's the latest Ottawa Real Estate Board data that actually says what's happening next in these areas? Be sure to watch. My name is Liam Swords. I make videos about living in Ottawa. I'm also a top producing realtor helping people just like you make Ottawa your home. Let's rewind to March 2022. Ottawa was at the top of the mountain. According to Ottawa Real Estate Board, the average sale price for residential property hit roughly $760,000, up almost 15% year over year. Detached homes were often selling well above $1 million, no conditions. Townhomes pushed past $800,000, $850,000 for a townhome, and condos were flirting with $500,000 mark. Unprecedented times. Inventory was at razor thin levels at 0.6% months of inventory, basically meaning everything for sale would vanish within the first 2 weeks. And that was reality, folks. Interest rates were historically low, 1-2%. That combination, cheap borrowing, panic buying, sent even the weakest neighborhoods soaring through the roof. But that's the thing. When the tide goes out, you see which neighborhoods were floating on hype and did not have strong foundation, as we call it in the real estate space. So what changed? Well, fast forward to fall 2025, we're in a completely different environment. Average prices are down 10-12% from that peak in March of 2022. The average residential sale right now sits at about $685,000. Condos are averaging about $400,000, roughly where they were back in 2020, so it's normalizing. And now we have about 4 months of inventory, which means we're in a balanced market. Buyers finally have leverage. They can do their due diligence as they should. This isn't buying bananas at Farm Boy. This is buying a residential home. It's not like, hey, can we return it? Like, you are buying a property for hundreds of thousands of dollars. So you should take your time and do inspections and have full due diligence. So when all of this happens, when the market starts to cool, when we become into a balanced market, the cracks start to show up. Some areas hold their value and others lag hard. And that's what I'm going to share with you. So the neighborhoods to avoid or to approach with real caution, because prices and demand and livability trends have weakened since COVID. This isn't about shaming neighborhoods. That's not what I'm about. I've been selling homes in Ottawa for 23 years. I'm a proud residential realtor. But what I'm here is to guide you so you can make an informed quality decision and protect the equity and knowing where the risk lies today, 2025, 2026. So number one, Rideau-Vanier. This is Lower Town ByWard market. If you want the nightlife, walkability, there it is. But from a resale and safety standpoint, proceed with caution. According to city statistics, Rideau-Vanier continues to rank at the top of the crime rate per capita in Ottawa. After short-term rental boom collapsed and investors pulled out, the condo resale value has dropped over 20% compared to 2022. Buyers are prioritizing quieter, family-oriented areas like Old Ottawa East and Sandy Hill. So while the lifestyle is great for young renters, owners and investors have faced higher vacancy and slower appreciation. I'll give you a very quick example right now. I have a property for sale on Lisgar. Beautiful condo. This particular client paid $356,000. We've now had to reduce the price down to $299,900, and we are getting the traction we need, and we're going to sell it. This particular seller has moved to Montreal for work. He knows he needs to sell. He's not upset. He understands the market. He's disappointed, but we are moving the product. But he's going to take like a $60,000 hit. That's the reality that we're in right now, folks. Another pocket to be careful of is Somerset Ward Centrepoint. The secondary would be Somerset and Centretown West. So this one hurts because it used to be one of the city's most in-demand downtown pockets. But post-COVID, it's being hit by 3 factors. Number 1, surge of new mid-rise condo supply. There's just an abundance of supply. Number 2, limited on-street parking. Now, the city of Ottawa is really pushing for no parking and LRT and public transit, but we're not really there yet. And number 3, a perception of declining safety in certain corridors, especially around Bronson and Gladstone. Ottawa Real Estate Board data shows the average condo prices here are roughly down 15% since 2022, while suburbs like Barhaven and Canada actually ticked up slightly. If you're buying for lifestyle, sure. But if you're banking on appreciation, Centretown's recovery has been sluggish. The third area to avoid and or be very cautious of would be Vanier, Overbrook corridor. This area has always been on investors' radar for up and coming potential. In fact, just before recording this video for you, I got a call from a client of mine who saw a pocket or a property on Deschamps. Looks attractive, is hot, except what can you build in that area and what's the long-term appreciation? We had a great conversation. He decided against going to look at it. Now, I'm not here to be Debbie Downer on this property or this area. I just want you to be careful and know where the long-term value lies. Yes, there's bright spots. There's new infill opportunities. Proximity to downtown is great, and solid zoning flexibility does make Vanier an option and something to consider. Just proceed with caution. But the truth is, prices here in the Vanier area were inflated the most during COVID and gave up the most after. Benchmark detached homes in Vanier have dropped from roughly $650,000 to the mid $500,000 range. And some semi-detached product has seen decline closer to 20%. Buyer sentiment has softened as renovation cost rose and flipping profits have evaporated. Number 4, Rideau-Rockcliffe. So border zones near Vanier Parkway and Saint Laurent. Gorgeous heritage streets like Linden Lee and Rockcliffe Park remain bulletproof. But parts closer to Vanier corridor face mixed demand. Buyers compare them to stable East End suburbs like Beacon Hill or Orleans Woods, where you can get large lots for similar money. These transition pockets can carry more risk in flat markets because appreciation relies on gentrification momentum, and that is slow right now. Something to be aware of. The 5th area, Alta Vista Industrial Belt. So the south central Ottawa area, especially near Smythe Road and train yards. We all know train yards. There's tons of shops and retail that we all likely frequent. This is an area where resale velocity has cooled. Homes close to hospital complexes are solid for rentals, but noise, traffic, and aging infrastructure mean buyers have become picky. Average days on market here nearly doubled compared to 2022. Number 6, our final area to be aware of would be rural outskirts. So where I mean by this is like properties that were on septic and well, more specifically Greeley, Osgood, and Carlsbad Springs. During COVID, these areas exploded. Everyone wanted land. People were working from home. They wanted to get away from the city. They needed privacy. Now, as offices have pulled people back into the downtown core, fuel costs have climbed. These long commute markets are cooling, and they're cooling fast. Some detached homes that hit 1.2, 1.5 million in 2022 are now selling in the $900 to $1 million range. And demand is softer outside the 30-minute core. So quickly to round it off for you, the Ottawa areas facing pressure since the COVID boom in 2022. Rideau-Vanier down 10 to 15%. Somerset Ward down 12%. Vanier Overbrook 15 to 20% down. Rockcliffe border 5 to 10% decrease. Alta, Vista, and the fringe area 8 to 10%. The rural pocket, so that Greeley, Osgood, septic and well area, 15 to 20%. Why these areas struggle? Well, there's 3 reasons why these areas have struggled. Number 1, over speculation during COVID times. Cheap credit, so cheap money, inflated everything, but especially the fringe and downtown investor zones. Number 2, the affordability squeeze. As rates rose, buyers shifted to stable suburbs with better schools and detached options. And number 3, lifestyle perception. People value safety, parking, and green space more than ever, especially after the pandemic. Areas that lack these are underperforming. So you're probably wondering right now, okay, Liam, you've told us all the areas to be careful of, but where is the stability? Where should we focus? Well, not everything is trending down. So I'm going to give you some pockets to consider. The suburb areas to consider right now would be Barrhaven, Canada Lakes, Stittsville, Finley Creek. Urban areas, Westboro and Glebe, have largely held their value or even outgrown slightly. They combine family amenities, schools, shops, and recreation that appeal to the core buyer base. Those areas absorbed the post-pandemic shift beautifully. Fewer investors, more end users. So bottom line, Ottawa remains one of Canada's most stable real estate markets. But that doesn't mean every pocket is bulletproof. If you're buying in 2025 or 2026, buy smart. Research crime and development data and compare year-over-year sales data before jumping into an offer. If you want to fast track all of this, if you enjoyed this content, I have a link below that summarizes all of these areas to be aware of and the areas where there's upside potential. Be sure to check it out. It'll save you tons of time and money. And if you're wondering how all of this ties into the bigger picture, including whether we are actually headed for a housing crash, I break it all down for you right here in my next video. Be sure to check it out.